Hello there and welcome along to this special online pensions event brought to you with thanks to Bank of Ireland. I'm Gavin McLaughlin, Newstalk's Deputy Business Editor, and I'm here to help you prepare properly for your future. We've got an ageing population, people are living longer, so planning for your retirement has never been more important. Well, joining me now to demystify this whole area and answer some of your questions are Jill Kirby, a personal finance journalist and co-author of the annual Tab Guide to Money, Pensions and Tax, and Bernard Walsh, Head of Pensions and Investments at Bank of Ireland. Thanks for coming in, guys. Jill, I'd start with you.
Sure.
How early do you need to be thinking about starting a pension?
I think you should start a pension with your first job, first full-time job. And that means that you're, 22, 23 years old if you're a graduate, earlier still if you're a young person who's starting a new job. And the reason for that is because, if you put the minimum amount that you can put into a pension, say if it's a private pension, if you have joined a company that doesn't have an occupational scheme, let's start with that. It's about 10% of your salary. If you join an occupational company scheme, better, because they're going to really be contributing more. Yeah. But the point is that if you start really young, you don't really have to worry about adding more of your income every year. That 10% over a 40-year period or a 50-year period, I'm afraid, because in the future, your generation and younger people are going to be probably working until you're 70. So a 50...
Something to look forward to,
Well,
yeah.
I know, but 50 years worth of contributing a small amount of your income every year that you won't even notice. You know, it'll be gone from the bottom line of your paycheck. So you won't even notice that that 10% is gone. But as you increase your income, when you hit your 30s and 40s and 50s, 10% is a lot of money by then, hopefully. And that will be such a huge nest egg. And it will be investing, and it's invested, on top of the investments every year, the wonder of compound interest. You won't ever have to worry about retirement. If you start a pension early and just keep at it and keep contributing the same amount every year, and of course picking up the tax relief.
Well, I'm sure we've got a lot of 20-somethings watching this who probably haven't followed your advice and they haven't got one started just yet. But I wonder over time, as this kind of message gets talked about more and more, how have young people sort of been engaging with pensions? I might ask you this, Bernard. Would you say this generation of youngsters is maybe more engaged than previous generations were?
Yeah, I mean, certainly what we hear is that more younger people are asking about pensions in interview situations. The recruitment companies would tell you the very same. It is front and centre. I mean, I know last February seems like, decades ago at this stage, but pensions were a very big issue during the general election, and it is becoming more and more important an issue for people. And there's no doubt, if people can understand the benefits of that, understand particularly what Jill mentioned about the employer contribution. If you're saving, that's one person saving. If you've got your employer adding to that, that's two people saving into your pension fund, and it's just making it an awful lot easier. And we also talk about the difference between maybe automatic saving and active saving. So active saving might be, I want to save for a holiday, I want to save to build up a deposit to buy a house. But automatic saving is something that goes out of my account every month. And from the day, if you do it from when you start working, it becomes just part of what you do. And it becomes less of a burden. It becomes just an automatic thing that you do.
Yeah, so you've almost forgotten about it. Sorry, Jill, you were going to come in there.
I was going to say, youngsters watching this might not remember something called the special savings accounts, special investment savings account, SSIAs. But they happened, 15 years ago. And what was tremendous about those is that the government was topping up the maximum contribution of €200 with 50 euros. And so many people, do you remember, Bernard, at the beginning said, oh my God, I couldn't possibly save that amount. I can't save 100 or whatever. But those that did very quickly adjusted to that money coming out of their accounts. And for 5 years, it built up and built up, especially the ones that were invested. And that's the same thing with a pension, as you say. You don't notice it. Within a couple of months, you wouldn't notice the money that you have allocated to your pension disappearing and not being there.
And to add to that point, a very sizable percentage of the people that took out that scheme that said, I could not do this for 5 years, are actually still saving. and they're still putting aside even the same amount.
And we've certainly seen a big spike in savings in the context of this crisis, which we might get on to talk about in a little while. But I wanted to come back to the point you raised, Jill, about starting a pension with your first job, and ideally your workplace would have one. Can you just give me an idea? Do most workplaces have pension schemes now, would you say?
Unfortunately, no. And that's part of the problem, is that over the years, many companies have either stopped the very generous defined benefit pensions. There's a lot fewer of those, absolutely. And a lot of companies, smaller firms in particular, don't have occupational schemes. You're better off probably working, you'll get one if you're with a larger company. And that really is something that has to be addressed. The government's been talking about addressing it for, 20-odd years or so with auto-enrollment pensions. So a lot of people are left with joining a company, not having the chance to have that extra contribution from the employer. And unfortunately, too many companies don't even offer, and they're legally obliged to, depending on their size, to offer a PRSA, a private retirement savings account group scheme. They're not obliged to contribute to it, but they're supposed to have one available, for people to be able to put money into, and they have to facilitate that money coming out of their pay and going into this group scheme that you're able to choose. So it's not an easy situation. The government has said that for many years that they want the auto-enrollment scheme to be set up. It was supposed to be 2022.
So this would mean that your employer has to have a pension scheme,
right.
and they have to contribute to it, basically.
That's right.
Yeah.
But it is so far behind in terms of the logistics of it. I don't think industry is completely behind it. Certainly, small companies, you probably have a better knowledge of that. I
think what they
are supporting it.
The idea, I think, most people would welcome. The idea that something mandatory is probably needed at this stage, but a lot of companies would say, how could we possibly afford it? And we've mentioned
post-COVID,
the crisis we're in at the minute. Could companies actually afford it? But I think generally people will say we've had the incentives, and I know we'll talk about tax in a while, but the tax breaks have been the carrot, but we've never had a stick, which is the stick that said, you have to do this. Now, they've had it in Australia, they've had it in New Zealand, really, really successfully, where it's just part of what you do. When you start work, that you pay, and your employer pays. And when they factor in the cost of employing somebody, that's part of the cost.
And they have talked about doing it here, of course, for a long time, and it's kind of been kicked down the road a fair bit. So
it's been introduced in the UK, though. I mean, the NEST, NEST, that compulsory pension scheme is in place. Millions and millions of workers are now signed up to it. The problem with those schemes is that the contribution level is, I think, probably too low for too long. It's 2% and 2% from the government and from the employer. And to be honest with you, I think 6 or 7, 8% isn't enough. You really do have to contribute more into a pension than that.
I'm not even sure I'm managing that at the minute, but we'll leave that for another day. Now, so we've established most workplaces don't have
about
these
half
schemes.
About half.
So if you're one of these people who don't have an occupational pension scheme and you're looking at an option for what you should do instead, Bernard, what are your options?
There are plenty out there, and good news is, I suppose, what has been quite a complex pensions landscape is hopefully going to get simplified by some interdepartmental government bodies have put forward some suggestions in that regard. But the most simple one is what's called a PRSA, and Jill just mentioned that there a moment ago. A PRSA is your own personal savings arrangement. It's very, very simple. You can contribute to it. Your employer can contribute to it if you have that arrangement with them. And if you decide, I'm working in this employment today, I'm going to move to a different employment, generally the rules are that you're meant to be able to take that with you. Now, there's some practical issues that might arise in relation to that, but it's quite a simple system. The charges are dictated by government. The range of the types of ways in which your pension is invested are generally quite middle of the road to make sure that you have a reasonable level of choice.
And how do you set this up? You go to a bank like yourself, is it basically?
Yeah, you can go to a bank to do it. Go to a financial advisor will set that up for you as well. And it's quite simple. Just identifying the key things to identify for any individual are, what can I afford? So the 3 steps we generally say to people is, look at what you have, look at where you want to get to, and then what can be done to get you there? Those are the 3 simple steps we generally recommend people follow.
And another option is self-administration, of course. What would you say about self-administration?
My views about that would be that it's extremely complicated. It tends to apply and maybe be appropriate for people who are on very high incomes, who are, own their own companies, who have a lot of money. I think they tend to be quite expensive. You absolutely need specialist advice for something like that. I mean, I've been self-employed for most of my life on contracts to different companies and newspapers, and I have an RAC. I just have a private pension scheme, which has been completely suitable and successful, but mainly because I've always taken very good professional advice about it.
Yeah.
And self-administered schemes, they haven't all worked out, and some have even been withdrawn, haven't they, and closed down, partly because I think there's some caps on charges and things now. And financial advisors are finding they're not really worth their trouble to do them. They're complicated. So if you do want to go the self-administered route, and it gives you much more freedom to put assets into the pension that you might not get from an ordinary retirement account or a PRSA, they're riskier. I've kind of looked at them. I've spoken to financial planners about them, and I think the good ones don't really think they're that suitable. People think they can put property and, especially property that will hopefully, some of them even think this is property they can actually live in someday. That's far from the case. You can't. It has to be entirely separate from all of your other pension things. So they're not.
It has some uses where you need to have a reasonably chunky pot of money that you can put into it, first of all. The second thing is you need to be very actively involved. You need to be, as Jill mentioned, buying a property, you need to be the one that's managing that. Yeah. You need to be making the decisions about when you buy, when you sell, managing tenants and so on. What most people do is they will pick an insured pension arrangement where you've got a life company or some organisation who will decide how the assets are allocated, and they'll try and find a mix that is suitable from an attitude to risk perspective to the individual. And instead of you deciding, we're going to buy these shares or buy that property, you're paying a professional to do that for you. So it depends on which road you want to go down. But what you were talking about in terms of the entry level, the person starting off, someone coming into employment, absolutely not.
Yeah.
It's the go for get a good starter pension, and if you build up a big pot over time, and if you have the time to make the decisions. But generally what we find is a lot of business people who like the idea of, I decide how my pension's invested, they're far too busy. The reason why they have so much money is because they have worked so hard to get there.
There's also the danger of not talking about self-administered ones, but even choosing the kind of insured pension scheme, pension fund that Bernard's talking about, is that there's almost too much choice out there for people who don't really understand the assets. They don't understand the risks involved. They don't understand how the markets even move. And I agree with you entirely. I think you're better off getting a highly diversified pension fund, well run, with as many funds and asset types in there. So from stocks and shares and property and bonds and cash, and maybe less cash these days because interest rates are so poor.
That was the next thing I wanted to talk to you about. Obviously for investment advisors, very, very challenging time at the minute. Cash, as you mentioned, you've got negative interest rates, really, really difficult. So how has your thinking, Bernard, changed in this market vis-a-vis asset classes?
Yeah, we talk about the markets every day of the week to groups, and there are days when I've got to rewrite my content on, even during a talk, because the markets change so much at the moment. The lessons that we learn, and history repeats itself over and over again in the investment space, is when you're younger, you should try and get as much growth as you can. And as you get closer to crystallizing your benefits, when you get near your retirement age, then maybe you need to manage the level of risk that you have taken to reflect what you're trying to get to. And what we saw, if you just take this year as an example, January, markets continued to do very well, shares were going up, bonds were going up, and then we had the sharpest sell-off of all time during February and March. But during that time, and into the summer months, we had things like government bonds actually did very, very well. So those that had the diversification that Jill referred to, the mix of shares and bonds and property, didn't suffer the extreme movements of stock markets. They did reasonably well. And if you look at where people are today, most people have recovered most of the losses that were experienced in February, March, and are in a lot of cases are well into the black again.
One of the great dangers, though, now, and it's a very difficult thing for fund managers to deal with, is that, as you quite correctly said, you've moved your portfolio into less risky assets over, as close as when you get to the pension time. But there is no return from cash, and that's the safest. And too many Irish people, when they're older and even after retirement, have left too much money in cash. Now, that's not the sort of thing you want to say to a banker, but you really shouldn't have so much cash, because it is going nowhere, and it's a guaranteed way to lose money as you get older if you leave it all in cash, whether it's just in a deposit account or whether it's in an ARF, an approved retirement fund, which is one of these things you can do after you retire. So I think you really need to take, and it's so volatile at the moment. If you're choosing asset classes, you're adjusting your pension, or you're retiring, you've got to get some really independent financial advice about what that portfolio should be representing, and understand more about risk. And leaving money in a bank account, I think, is very risky.
Well, do you think
it's much better to invest your money, I think.
You're watching a special online pensions event brought to you with thanks to Bank of Ireland. I'm Gavin McLaughlin, Newstalk's Deputy Business Editor, and I'm joined by Jill Kirby, personal finance journalist and co-author of the annual Tab Guide to Money, Pensions and Tax, and Bernard Walsh, Head of Pensions and Investments at Bank of Ireland. Jill, you were talking there about kind of taking the time to understand what you should be doing with your investments and the problems with cash at the moment. Would you say the COVID-19 crisis has meant that people are maybe taking a bit more time to worry about these things, if you like?
I really hope so. I've been writing about this for 7 months, saying, you're at home, you're bored, yes, you're busy working perhaps or taking care of your children, but we all have more time on our hands. And instead of maybe watching the 8th box set of the month, sit down with your spouse or partner, start looking at a few of the things you've been putting off. And certainly pensions, I think, is one of those, it's a good idea if you have an occupational scheme, great. Hopefully it's being well managed. If you're self-employed and you haven't looked at your pension in 10 years, and a lot of people don't, I mean, what a great time to finally sit down, look at it. And I'm sure you've advisors who are at home on the phone, though, with people. They're not meeting them in person. And I know most financial advisors are there to take Zoom calls, and you should be doing that. You really should be. If you haven't really taken a look at what's been in your pension for a while, and the closer you get to retirement, of course, you should be.
Well, because we have seen people, they're certainly thinking about it in terms of putting more savings away. The figures show that. But I wonder, Bernard, should they be saving it in bank accounts? Obviously, you work for a bank, so maybe you're a little bit conflicted here. But from a pensions point of view, some of this savings could be going into pensions.
Yeah, I suppose it's really there's an exercise that we encourage people to take, which is just to sit down and again, right at this moment in time, if people are at home, you maybe have a bit more time if you're in a relationship, if you have a spouse, that maybe a bit more time to just look at the overall family finances. But a quick sense check. What's coming in and what's going out? What do you have and what do you owe? So that's a simple enough exercise, and you'll do that by just having a look at your bank statements, your online accounts. So what's our current position? So where do you stand at the minute? And then look over the next maybe 2 or 3 years. What are the major big expenditure items that you may have coming down the road? And just getting a good sense of, what debt do you have? Am I managing my cash? Am I earning nothing on this side and paying 20% on that side? So a few simple exercises like that can actually generate a lot of savings.
And what are you finding when you're talking to customers in terms of, are they happy with what they have at the minute, or are they kind of realising, I'd like to have something a bit better?
One word we're coming across again is stress. People are more and more uncomfortable about their finances, stressed by their finances. And what Jill mentioned earlier, the traditional defined benefit pension scheme where you worked all your life in a job and you got a guaranteed income for life from your employer, that's all gone. Now we have to take personal responsibility for it. And more we're hearing from people, I don't understand. I need somebody to help me. Make it simple for me is the big phrase we heard. A lot of research with Red Sea recently, which just said that to us. Make it easy for me to understand. And financial well-being is something that we have invested very heavily in to try to really bring people along with you along that journey. They don't want to be talked at anymore. They really want to be people to really just help them to understand what is really going on with their finances. And that guy that you might remember from the ad on the television, I don't know what a tracker mortgage is on a bus. You know, that guy today, I'm sure, does know what a tracker mortgage is and wants to know what's his pension about? What is my pension all about and how does it work?
Have you anything to add on that, Jill? Do you think people in general are dissatisfied with what they have, or are they trying to learn a bit more?
I think so, but I also think there's still a lot of inertia. You know, especially people who have a pension scheme or belong to one, the lack of knowledge about how much the company is putting in, how much it's worth. They get an annual statement every year that they don't bother looking at. And that's why I'm saying this probably is the best opportunity, an unfortunate one, to take the time. So much is changing, and so much is going to change in the future, too. I think between the endless pension commissions looking at how complicated pensions are in this country and how serious the problem is in terms of the state pension, you know, it's going to come upon you probably sooner than you think that you're going to be facing changes, whether it's involved with paying more tax, maybe not having the same amount of tax relief, who knows? And certainly for younger workers, the amount of time that you're going to have to keep working before you're going to be able to claim a state pension. So all of those things have been exacerbated by the great pandemic and by, I think, what will be quite a few serious financial difficulties coming down the road. We have to pay for all of this.
Yeah, I mean, they call it the time bomb, don't they? It's the ticking pensions time bomb.
And throw the pandemic costs on top of that.
Yeah,
you know.
So very, very difficult. Now, we talked a bit about auto-enrolment earlier, which is probably one of the solutions, if you like, to this, but it's not the only one. I mean, what would you say, Jill, needs to happen to try and come to grips with this time bomb that's ticking?
Do you know, I think auto-enrollment is the solution at this stage. We've gone through, you know, companies like Bank of Ireland and the life insurance companies, they have spent fortunes on trying to explain pensions, of you know, spending a lot of money on advertising and promotions and booklets and everything else. And it hasn't really worked. The numbers of people who are covered by pensions is still falling. It's not getting larger. For all of your efforts, for all of my efforts, to convince people to join a pension scheme. And I think auto-enrollment is something that just has to happen. But again, governments don't like looking further than the 5 years down the road that they're in.
And they're afraid to put up the pensions age. I mean, we've seen that.
I mean, you know, it is a very difficult subject. You don't get a lot of votes for it, for doing the right thing. And so until auto-enrollment comes, I just hope that people, you know, use this opportunity to review their finances and to look a little bit further down the road at retirement, which comes, I can tell you, it's coming a lot sooner than you may have thought. You know?
I do think, you know, again, back to the understanding piece, that a lot of people perceive a pension and saving for retirement as being something that's miles away, but also that it's a fixed commitment. That if they sign up to something or they agreed to something, that they're stuck with that and you know, they have this fear that if I need this money, that it's tied up in some way and I can't get my hands on it. And, you know, if I can't afford to pay it in this month, will it mean I will have to do without food to pay, to pay for my pension? And the reality is that they really are flexible arrangements. There are people who pay in once a year and they pay in what they can afford that year, or they can pay in an amount to reduce their tax bill. There are people who, and we do recommend paying in on a monthly basis is an easier way from a cash flow planning perspective. But anybody can stop and restart and do a smaller amount for the next 6 months if they so wish.
Well, that's a good point, because there used to be penalties for doing that. They're pretty much gone now too.
Yeah.
So you're right about that. I mean, but even getting that information across is not easy. I've been trying for 30 years to impart on my colleagues in the financial press, and I know corporations, big companies involved in pensions have been doing this too. So keep up the good work, I suppose, for all of us in trying to raise awareness. But this really has come to a point where it needs a big government intervention. And they laid out the groundwork for that with the auto-enrollment pension. Let's hope that they actually do it now.
I'm not holding my breath,
No,
but
and it's
let's
not
see.
going to happen
Let's see what happens.
I don't think.
Okay, really good discussion, guys. Thanks very much for that. We might get on now to some of the questions that we've got from viewers. So, Jill, I'll ask you this first one. It says, "Hi, I am a PAYE employee, but also rent out an apartment and have rental income from that. I understand there are tax benefits of putting some of this income into a pension. Can you explain this to me in an easy to understand way?" So they're really putting it up to you there now.
Okay. Well, listen, whether you get income from your job or from a rental property or from shares, I mean, it's all income. You're going to be paying tax on it. And unfortunately, people who own property tend to be paying tax at a high rate. There are no great tax breaks at all for owning a rental property anymore. And there's a lot of costs involved in running a rental property, as people say. So I'm surprised that anybody has any profit left over from rental properties these days. But if they do, and they want to top up their pension, if they're members of an occupational scheme, they could put it into an AVC. That's an additional voluntary contribution. You will get tax relief on the contributions that you make. It's 40% at a higher rate, it's 20% at a lower rate. So by all means do that. I mean, go to a financial advisor and say, believe it or not, I have extra income from my rental property and I'd like to put it somewhere sensible. And I think, because of the tax breaks for pensions, for higher and standard rate taxpayers, it is still one of the last really good tax breaks that you have out there. And it astonishes me that people don't top up their pension, because every €100 you put into a pension, you're only paying 60 if you're a marginal higher rate taxpayer. And all that money really adds up.
Oh, it certainly does. Yeah,
so speak to an advisor and make their day by saying that you actually have money to invest.
Okay. Very good. Okay, and this person here, Bernard, says, "I have heard that starting a pension early is important, but what are the real advantages?"
Well, the big advantages, I suppose, I mean, that we would point out to people are all linked to having a nice lifestyle when you retire. It is about you're going to work hard for a very long time. When you stop working, do you want to be able to continue to enjoy life? Do you want to be able to go on holidays? Do you want to be able to enjoy meals? Or do you just want to have a decent standard of living when it comes to retirement? For some people, if you were to take somebody on the average industrial wage, if they move from that to the state pension, that's about a 70% cut in earnings for them. And that's a very, very sudden drop.
Sure is.
And there are people out there that I know that during this crisis have experienced drops of that of that size, and it's a real struggle for them. So, but it is about, a lot of people think that I'm putting my money into a policy or putting my money somewhere else. All you're doing is deferring spending. All you're saying is, I'm not going to spend everything I earned today. I'm not going to consume all of what I've got. I'm just going to put some of it away, and I'm going to spend that sometime in the future. And while I put it away, I'm going to just see what I can do to make it grow, so I can do even more with it into the future. And that's what it is at its most basic.
Okay. Next question, Jill, I'm going to give to you. We've kind of covered this earlier, but no harm to do it again. This person says, "What is the difference between a pension and a PRSA?"
They're both pensions. That's the difference. Our system, as Bernard was saying, and the government's new pension commission is yet again looking at, is very complicated. There's too many strains of pensions in this country. And the PRSAs were introduced 20-odd years ago to try and simplify that for ordinary people. It is a personal retirement savings account, which means that you can take that personal fund with you from job to job. If you join an occupational scheme, if you leave the company, it either gets kind of frozen with them if that's what you choose, or you can transfer it, but it's complicated and it'll cost you money. So the PRSA is I've always been a great fan of it, and I'm really sorry that more people don't have it. But it kind of got abandoned, didn't it, by the government? They didn't push it very hard after the first few years. Again, governments don't like dealing with pensions, you know. It's complicated for them, there's no votes in it.
Yeah.
So there's no difference except that it's not an occupational scheme because you don't belong, you know, you don't have a chance to belong to that. You can buy one if you're self-employed. If you're with a company that doesn't offer you an occupational scheme, that's the one you probably should have, or at least start out with that. Okay. And as you know, as your career develops, if you become a company director, then you can go to something a little bit more sophisticated. But for the moment, I think it's probably the best starter pension.
PRSA is the way to go. Okay, this one for you, Bernard. This person says, I'm really considering starting a pension now. I really couldn't face being one of those older people who have been contributing to a pension for years for it to disappear or not materialise. What are the safeguards and regulations, and can I pick the risk level of the pension?
Yes, you absolutely can. And I mean, any advisor that you meet has two real key requirements about the advice that they give. The first one is they have got to be able to prove to you, the customer, that what they recommend is affordable so that you can put this amount aside. And the second thing that they have got to be able to prove, and again in writing, is that what they recommend is suitable. So they will do an assessment of you and what is suitable for you. And different people are looking for different levels of risk, and Irish people, in my experience, tend to be relatively cautious. Most advisors use a scale of between 1 and 7, with 7 being the highest level of risk and 1 being the lowest. And most Irish people come in around 3. Now, that's okay, but what it can mean sometimes, if you're too cautious, you won't get enough growth in your money. And Jill referred earlier on that there are certain things like cash and some of the parts of the bond market that are, you know, won't deliver a lot of growth for you. So while your money's there, you want it working for you as well. So it's just understanding what's suitable for you. The advisors and it's really important that what you put your money into is something that is regulated, that, you know, you hear it on the ads, the entity is regulated by the central bank. It's really important. Whoever you're dealing with is properly authorised, and you can check with the central bank on their register to make sure that whoever you're dealing with is properly authorised. Big thing, when you come to retirement, you want to be absolutely sure that the entity that you're dealing with is still there to provide your benefits when you come to retire.
Well, definitely no doubt about that. Okay, thanks very much for that, guys. For some very, very helpful tips there, and I know they'll have been very helpful for the people watching at home. So that's it for this special online pensions event, brought to you with thanks to Bank of Ireland. Thanks indeed to Jill Kirby and to Bernard Walsh, our guests. And thanks to you for watching. We'll see you next time. Take care.